In this module, we're going to briefly discuss the Black-Scholes formula. The Black-Scholes formula is of great significance. It's used an awful lot in industry, and indeed we can view the binomial model as an approximation to the Black-Scholes formula. Black-Scholes assumed a continuously compounded interest rate of R so that $1 invested in the cash account at time 0 would be worth e to the RT dollars at time t. They also assumed geometric Brownian motion dynamics for the stock price so that the stock price at time little t is equal to the initial stock price times the exponential of this quantity here, where Wt is a standard Brownian motion. And for those of you who are interested, we have recorded separate modules on both Brownian motion and geometric Brownian motion. These modules are available on the course website. They also assume that the stock pays a dividend yield of C. They assumed continuous trading with no transactions costs, and they also assumed that short selling was allowed. So here are some sample paths of geometric Brownian motion. They look quite similar to sample paths of Brownian motion, actually. You can see that the stock price never jumps here. So at no point do you see the stock price, say, jumping from here down to here. So that's a property of Brownian motion and geometric Brownian motion. The sample paths are actually continuous. Given the assumptions that Black-Scholes made and that we listed 2 slides ago, they succeeded in deriving the price for a European call option with strike K and maturity T. It is given to us by this quantity here. It's a somewhat complicated looking formula, but it's easy to code up, and it is used everywhere in industry today. The interesting thing to note about this formula is that mu, which was the drift of the geometric Brownian motion 2 slides ago, so recall, we assumed a drift of mu here. Well, if you notice over in the Black-Scholes formula, mu does not appear anywhere. And this is similar to the fact that P did not appear in the option pricing formulas we derived in the context of the binomial model. We'll return to that in a moment. So European put option prices, P0, can then be calculated from put-call parity. So once we have the call option price up here, we can price put options. In other words, we can derive P0 using put-call parity here. And this is the version of put-call parity that applies when we have a dividend yield. Black-Scholes obtained their formula using a similar replicating strategy argument to the one that we used for the binomial model. In fact, you can show that under the Black-Scholes geometric Brownian motion model that we can write the price of the option C0 as being the expected discounted payoff of the option using risk-neutral probabilities Q. This is exactly the same formula we had for the binomial model. In this case, however, in the continuous time model of geometric Brownian motion, under Q, we assume that the stock price is given to us by this here. And the only difference between this expression for ST and the expression we had for ST a couple of slides ago, which was mu minus sigma squared over 2 times T plus sigma WT, is that we now have a factor R minus C appearing here, which we don't have down here. And the true drift of the geometric Brownian motion mu no longer appears in the option pricing formula. This is exactly analogous to the fact that we used the risk-neutral probabilities Q and not the true probabilities P when we were pricing options in the binomial model. So in fact, if you evaluate this expectation, assuming ST is equal to this, you'll get the Black-Scholes formula. And for those of you who are interested, it's actually not very difficult to do this. It involves an integral of a log normal distribution. ST here will have a log normal distribution, so one can actually evaluate this, do some integration, and actually get the Black-Scholes formula that we showed on the previous slide. The Black-Scholes formula is used a great deal in industry. In fact, it is the way in which option prices are actually quoted by industry practitioners. The binomial model is often used as an approximation to the Black-Scholes model, in which case one needs to translate the Black-Scholes parameters, or sigma and so on, into our familiar binomial model parameters. This is often referred to as the calibration of a binomial model. So suppose we're given some Black-Scholes parameters. We have R and we have sigma. And if you notice over here, that's all we need. We have R, we have sigma, we also have C, of course. And we'll see how to calibrate these and rewrite these parameters in our binomial model. So what we'll do is we will write Rn, and now we're going to have subscript n here to denote the fact that these parameters in the binomial model will depend on the number of periods that we're using in our binomial model. So recall, if t is the maturity of the option, then t is equal to n times delta t, where delta t is the length of a period in the binomial model. Okay, so we're going to assume that Rn is equal to e to the rt over n, where n is the number of periods, as we said. We'll assume that Rn minus Cn, so this is Rn minus Cn in the binomial model, will be equal to e to the r minus c times t over n. And a simple first-order Taylor expansion will tell you that this is approximately equal to 1 plus r t over n minus c t over n. So this, of course, is like our r factor, and this is our c factor in the binomial model. We'll set un equal to this and dn equal to 1 over un. And now we can price European and American options and futures and so on as before in the binomial model using these parameters. The risk-neutral probabilities will be calculated as q subscript n. Again, recognize the dependence of our parameters on n, the number of periods. So q subscript n will be equal to this here. And using this approximation, we can see that this is approximately equal to our Rn minus Cn minus Dn divided by un minus dn. So this is the representation of the risk-neutral probabilities that we saw before in the binomial model. We're actually going to use this in our binomial model now when we're deriving our parameters from a geometric Brownian motion and the Black-Scholes formula. So our spreadsheet will actually calculate binomial parameters this way. I mentioned at the beginning of the module that the binomial model can be viewed as an approximation to geometric Brownian motion. This is true as delta t, the length of a period, goes to 0. And I'm just going to spend a couple of moments describing how you might go about showing this. We certainly won't go through all the calculations, but I'll do the first couple of steps of these calculations. Recall that we can calculate European option prices with strike k according to this expression here. So this is the expression we had in our binomial model. C0 equals the discount factor times the expected payoff of the option using the risk-neutral probabilities Q. Well, if you recall, we also saw that we can write this expression as we have written here. So these are the binomial probabilities. Okay, so this here is equal to the probability in our binomial model of j up moves and n minus j down moves. And this then is ST, the terminal stock price, after the j up moves and n minus j down moves. So therefore, this here is the expected value of the payoff of the option. So what you can do is we can actually replace this summation, which runs from j equals 0, to run from j equals, let's call it eta, say, where eta is the minimum j such that the stock price, again, this is ST, after j up moves and n minus j down moves. So eta is the minimum number of up moves required to ensure that the stock price is greater than or equal to k. In that case, this maximum will always occur in the first argument here. So we can remove the max, remove the 0, and just substitute this expression in here inside the summation, and then we can split the summation up into two components as we've done here. So what you have is we can rewrite in the binomial model, we can write C0, the initial value of the option, as being equal to S0 times some quantity minus K times some quantity. And if you recall, that's exactly what you had in our expression for the Black-Scholes formula. We had S0 times some quantity minus K times some quantity. What you can do, and we won't do it, but you can show that if n goes to infinity, or equivalently if delta t goes to 0, remember capital T is fixed, so if n goes to infinity, delta t goes to 0. You can show that if n goes to infinity, then C0, as we have here, will actually converge to the Black-Scholes formula. Very briefly, there is some great history associated with the modeling of Brownian motion and geometric Brownian motion, stochastic calculus, and finance and the pricing of options. There are many famous names, both mathematicians and economists, who are associated with this history. You might want to take a look at some of these names in your spare time. I'll just throw out a couple of very interesting people. Bachelier back in 1900 was perhaps the first to model Brownian motion. He was attempting to do so with a view to pricing options on the Paris Stock Exchange. Another fascinating person is Dublin, another French mathematician whose work was only recently discovered. He was actually very involved in the development of stochastic calculus, but his work wasn't discovered until very recently, as he died in World War II before his work could be read. Another very influential person or fascinating person is Ed Thorpe. Ed Thorpe is famous for card counting and showing that you can actually card count and beat the system in Las Vegas. After he was thrown out of Vegas, apparently he started trading options and may well have been the first person to actually discover and use the Black-Scholes formula. He didn't actually prove it was true. He didn't have a model which derived the Black-Scholes formula, but it seems like he somehow intuited that that might have been the correct formula for pricing options. And there's a host of other interesting names here that are well worth exploring.